One of the most important things in any investor's portfolio is its uncorrelated performance. What I mean by that is your portfolio should not only be doing good when the economy is doing good. Essentially, you want it to be doing good when the economy is doing bad and when the economy is doing good. And the only way for that to happen is to make sure that you are diversified in a multitude of different assets. And in this video, I want to go over a very particular investment that has allowed the perfect uncorrelated opportunity that I have instilled in my portfolio. But enough rambling, let's see how it did. Welcome back. My name is Matt Jimenez. I'm an entrepreneur who has worked with the greatest minds in finance over the last several years, and I'm here to pour into you guys everything important to me. And the importance of this video is going over uncorrelated assets. Reason being is because I believe moving forward into 2025 and 2026, after the new election that's occurring and how poor our monetary and fiscal policies have been over the decades, I believe there is going to be a massive reform in our economy. What I mean by that is I believe there is a recession that is bound to happen within the next year or two. And why is that important? Well, Hillary Clinton said it best. Not that I'm a fan of her, but she said this:
never waste a good crisis.
And we all know the philosophy of buy when there's blood in the streets. So with that being said, and all the mayhem that is happening in our economy today, you want to make sure that you have the ability to mitigate the risk of being exposed to the economy's performance. The only way to do this is through uncorrelated assets. While I believe coming in the near future, there's going to be a massive recession, there is also going to be massive opportunity, not only to buy up tons of assets that you want to get your hands on that are way too overpriced today, but also the ability to allow your portfolio to continue to perform in an automated fashion using algorithmic trading softwares. And in this video, I'm going to show you the exact data of what has happened during massive market pullbacks in the S&P, which we all know today is a uniform measurement of how the American economy is doing. While it may or may not be accurate, that's irrelevant. What we're looking at here is just the data of what happens and how you can find performance regardless of what the S&P is doing. And I bring the S&P up because it is the most common asset that people end up holding in their portfolios. So without further ado, let's check the charts. Here we are. This is the S&P 500. And what I've done is I've just hovered my cursor right above July 2023. And what I'm going to do is I'm going to use the measure tool that they have on TradingView. I'm just going to measure how great of a decline there was during this time from July, essentially all the way to the beginning of November, late October. And the reason being is because I want to actually compare what the software did during this time. So let's see how much of a decline this is. So from July 26, 2023, all the way down to October 27th of 2023. That was a 10.82% decline in your portfolio, considering you're holding the S&P 500 as one of your assets. And then next, I'd like to actually see how long did it take for us to recover that back, considering you were holding the S&P 500. Surprisingly, we actually made that recovery quite fast, considering how long of a drawn out process that was on the way down. We recovered that back in just about 2 months. So from the end of October to the end of December, we actually ended up recouping all those gains. Typically, that's not common in the stock market. Right now, it is common with all the stimulus happening to keep the stock market afloat, to make the economy seem like it's doing well and ensue more investment. Typically, back in the day, the stock market used to reflect the American economy's performance as a whole. But in today's age, they're completely decoupled, and this is something I've spoke about quite often. If I was to go back through history and show you guys, typically a recovery out of a real recession would take a decade or more to recoup. And that is with the malpractice of stimulus pumping to artificially pump up the stock market to make the economy look like it's doing good. But anyways, now let's compare this 11% crash to how the software did. So here is the software's performance back in 2023. And if you look at the month that the stock market started to sell off, we actually did a 19% gain for the month of July. This shows the true power of having an uncorrelated asset in your portfolio. Meanwhile, the stock market is dumping, your portfolio is still being active to the upside. So from July all the way to October, that would be a grand total of 39.41%. And no, I'm not a math wizard. I actually secretly just pulled out my calculator and calculated that quickly. But from July at a 19% gain, August at a 4% gain, September at a 6% gain, and October at a 9% gain. During that time, the market was selling off aggressively and you lost about 11% in your portfolio. Meanwhile, anyone who had algorithmic trading to substitute the lack of performance in equities, you would have been able to possibly gain a 39% growth on your portfolio considering your risk settings. Of course, this account is set a little bit more aggressively, so of course the performance will vary depending on what your settings are as well. But again, I'd also like to look at September, because we had a sell-off in September all the way to October, which was a 6.73% loss on your portfolio. Again, during this time, the algorithm had no problem performing. During September, we did 6.68%, almost 7%. Meanwhile, the stock market bled almost 7%. And then again, let's check this out right here. So for the month of October, there was another 6% pullback in the S&P 500. Now let's look at what the software did for the month of October. It was 9%. So it is completely uncorrelated. As you could see, whether the stock market goes up or down, it's kind of irrelevant to how this software is performing. One, because obviously it's trading currencies, but two, it's playing the long and short side of things. So it's not really holding on to a position, hoping that it goes up in value. It's just capitalizing on micro movements with X amount of leverage to make sure that you can actually feel the change in the markets, even though it is small increments that it is capturing. Now let's go over to recent times. Let's see how this did. This sell-off here happened in April of 2024, so this year. And this sell-off was about 6% even. So April was a 6.79% gain for the algorithm. Meanwhile, again, the S&P sold off 6%. I think it's actually kind of ironic. There's been multiple months here that I've pulled in comparison with the software, and they're almost complete flip. If it's a negative 6% for this S&P, it'll be a positive 6% for the algo. And no, that's not like 100% given. That's just what I've seen on this, ironically. Now, currently today, we are experiencing a bit of a sell-off, and it happened to start around July 16th of 2024. So from then to now, which is the 21st of July of 2024, we have experienced a 3% sell-off so far, and I actually believe that we are headed a tad bit lower. Hopefully I can look back at this video and say, wow, good call, Matt. I believe that the S&P 500 is going to drop down to fill this gap here, but also come a bit closer to the moving averages. So I believe the S&P at 5370 is where we're headed, and that means we have a bit more to sell off here. So currently we are down 3% on the S&P 500, but let's look at how the software is doing at the moment. And of course, ironically, it's up 3%, actually almost 4%, sitting at 3.74%. That is what I like to see for uncorrelated opportunities in a portfolio. You do not want to be in tandem with how things are going. You want to make your own path and make sure you're diversified. When the S&P is going up, real estate is going up, and all these other asset classes are going up, you want to feel the experience of it going up, but you don't want to be fully dependent on it, because then you're going to feel the experience of it on the way down, unfortunately. Having something like this in your portfolio to mitigate that risk on the way down so you could still perform during market crashes will really help you and help your portfolio long term. Again, this is the performance of 2023 every single month, and over here 2024 every single month has seen a gain, even though the S&P has not been able to say that for some time. If you found value in this video and you're interested in how you could potentially diversify your portfolio, hit the link down below. And if you want to skip all the fluff and get straight to answering your questions, hit the pinned comment. It'll route you to the team and you'll be able to hop on a phone call and see if this is a good fit for you. But if not, and you just found value in this video or just found it entertaining, please leave me a like, comment, and or subscribe. And like always, my friends, peace.